From New York City to our viewers worldwide, I'm Alix Steel in for Jonathan Farrow. Take a look at where we are. NASDAQ 100 continuing its record climb, pushing the S&P near a record. And small caps, no slouch either, up by 0.3%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Coming up, chip makers powering the latest tech-led rally. Congress averting another shutdown showdown for now, and the Fed set to go dark as the rate cut debate continues. And we begin with the big issue, the tech turnaround.
The poster child for high quality is the U.S. tech sector.
The big tech stocks.
The tech sector has done very well last year.
What drove the market last year was that magnificent seven.
We had the big AI boom pushing through earnings for tech stocks.
The AI hype.
Maybe we're seeing a little bit of that enthusiasm at the start of this year.
It's a positive background story for growth. For equities, and I think it's probably going to stay for a while.
Tech earnings are supposed to be up in double digits.
Valuation's already very high.
Expectations could be on the higher end.
We still like tech.
Big tech is absolutely fine.
You don't want to run away from big tech.
We still think this is a sector you want to be overweight.
The enthusiasm is there, the flows are there, and also the valuations.
It's not as if that the long-term themes around big tech have gone away. They haven't.
So far, tech stocks have been able to deliver.
Well, joining us now to discuss is Zachary Griffiths of CreditSight. Also, Morgan Stanley's Lisa Shallett will be joining us shortly. Okay, what I definitely don't get is why tech is rallying.
It's a good question, Alex. It's been an interesting start to the year. And when we think about what tech looks like from a credit perspective, looking at the bonds, it trades extremely tight. And so we're actually underperform on tech from a corporate credit perspective, at least in the investment grade space, as we think a lot of the good news is kind of priced into the market. And when you think about, at least again, from a fixed income perspective, credit spreads so tight, the opportunity to outperform in that type of environment is very limited.
Right, and we've been hearing a lot on the equity side about how positioning is really stretched as well. Now, you could look at it one way that, okay, TSMC yesterday, maybe the trough is in for the semis, and that's going to wind up helping overall tech. You could also look at it as maybe this is a safety play. No one knows what the Fed is going to do, therefore you need the safety. What do you think?
Yeah, I think the Fed argument is certainly there, and there's been a lot of uncertainty or at least repricing over the past couple of weeks in terms of the dovish pivot we got from the Fed in December, and now a little bit of a rethinking of can the Fed actually ease as aggressively as the market is priced. And while we think the Fed is closer to easing than it has been at any point in recent times, we also expect that there's only 100 basis points of rate cuts in 2024. So the market seems a little bit overdone from that perspective, and I think you could see a little bit more caution. So that safety argument certainly makes sense to us, Alex.
Yes, and everyone seems to agree with that. Mohammed Al-Arian of Bloomberg Opinion weighing in on that point, saying, I wouldn't be surprised if we start later, probably the beginning of the summer, and I wouldn't be surprised if we end up the year with cuts that are closer to what the Fed has signals, which is 75 basis points, as opposed to what the market has priced in. Bloomberg's Michael McKee joins us now. Mike, what are people talking about as we head into the blackout period?
Well, it's interesting because we've had a lot of Fed officials pushing back against the idea of earlier and more cuts, and the market is only just beginning to think about believing them. Here's where we are right now. I mean, over the course of this year so far, we've seen unemployment stay about unchanged, under 4%, while the PCE inflation numbers have come down regularly. And look at consumer spending going back up again. Now, Michael Gapin at Bank of America has a note out this morning saying, ignore that. It is just seasonal adjustment. The economy is cooling, and next week we'll get an idea of how much the economy has cooled. But as I said, the markets are taking this as an indication that either the economy is cooling and you need to cut rates, or the economy is just fine, inflation's cooling, and you can cut rates. And you look at what the Fed is forecasting, which is 3 rate cuts this year, and the market's still at 6. It's come in from 7, but still at 6. That's the white line there. And something's got to give between those two things. What we're looking at is a very, very slow change as Fed officials come out and talk about it. It'll be interesting to see in 10 days now whether Jay Powell pushes back as hard as others have. have, because at the moment what we're seeing is that there is no move expected for the January meeting, January 31st. But the December meeting still, as I said, the yellow line there pricing in a 68% chance of 6 rate cuts, while the March meeting, the white line, now down to just 51% chance of a move. So a slow move by the markets towards the Fed, but not yet where the Fed is.
It's still 51%. It's nuts. Hey, Mike, thanks a lot. Really appreciate it. All right, so Zach Griffith's still with us. Lisa Shallot joins us now. So, Lisa, the tension then in the market, which is going to explain all the other asset class moves, is does the market meet the Fed or does the Fed have to meet the market? How does that resolve itself?
Well, look, I don't think that we're in a period where there's any pressure whatsoever for the Fed to meet the market. You know, that usually happens during periods of distress. Right now, we have an economic backdrop where, you know, some of the growth figures, including retail sales, are surprising on the upside. The Fed has ample room right now to take its time to digest the data. Overall, capital markets are reasonably stable. I mean, equity investors may not be, super excited that the rally that we saw in November and December has stalled out a bit. But there is no crisis here. There is no one yelling fire in the theater. And I don't think the Fed has any need to do anything other than what they're doing, which is, you know, the Fed governors are out speaking, very data driven, very rational, and pushing back very softly on markets that just got ahead of them and unnecessarily ahead of them.
Which just begs the question, kind of the why behind the cut, Zach. Like, is it going to be because inflation's coming down, growth tanks, or just a normalization? Like, let's, cut a little bit here, wait and see, bring that real yield down a little bit, but not an actual sort of easing cycle, Zach.
That's exactly what we're looking for. And when we think about our call for rate cuts in 2024, it's really directly linked to our inflation call. We think that core PCE can move about 100 basis points lower, back toward around 2.25% by the end of this year. And so thinking about wanting to maintain the real policy rate more or less steady, maybe pull it back just a little bit, there's your 100 basis points of rate cuts. And if you look at the Fed's forecasts for core PCE and in the dot plot, they have 75 basis points of rate cuts and the pace of core PCE coming down just about that much. So we seem to be on the same page there. It's interesting to see the market move so much, and it almost seems as if the market had been pricing more of a recession type scenario, which isn't our base case.
Right, which then maybe that's why you want to go buy growth in tech, because now we're pricing that out. Still confusing to me. Lisa, so is it going to be a real cutting cycle or a normalization? And how does that change how you allocate?
Well, here's where I think definitions matter a lot. The market seems to think, on the positive side, I get a soft landing and all the improvement in profits that go with that scenario, a more accommodative central bank, but I don't, get any of the potential negatives, which is a softening potential increase in unemployment. I think, on the flip side of things, we have to, ask ourselves, could things actually be a lot worse, to your point, if the Fed's cutting aggressively is because there's a recession, and that's not what you're pricing. So it has been somewhat incongruous in this, scenario where investors are asking us to thread the needle of what the narrative is that's priced. It's not intellectually coherent, and it hasn't been for a while.
That's great. It's not intellectually coherent. That's probably the best way I've heard to describe what's happening in the market, Lisa. So is that scenario worth records in tech? Is it worth close to a record in the S&P?
So look, as you know, we've been skeptical that the Mag 7, the focus on these high secular growth, very expensive stocks can continue in an environment where, the economic growth is resilient and therefore interest rates are stable as opposed to going down. And so what we've said to folks is it's very hard to continue to justify a market that's going to be levitated by expanding valuation multiples. So the only thing to get excited about are those companies that can really deliver the earnings growth, because you just shouldn't be betting that multiple expansion is going to get you there. Certainly not if you're betting on this economic soft landing where growth is okay, which means the Fed doesn't have to cut much and isn't going to give you much relief in terms of lower rates.
So, Zach, if growth is okay-ish, what do we do with the 2-year, 4.38%? What's it worth?
We still think it could go lower by year end in terms of yield. And really it comes down to, we do think that the Fed is going to be normalizing policy. Even if you have okay-ish growth, our forecast is something in the 1 to 1.5% range, which is below potential. And if you think about the progress that we've gotten on inflation already, that's with GDP growth well above what anyone expects potential to be. And so we think the Fed is in a position to start easing gradually, even if economic activity remains somewhat resilient, but certainly has to come off the boil that we saw in terms of the numbers in the middle of 2023. So we think that that creates a positive backdrop, certainly for corporate credit, but spreads have tightened in a ton already. So we're starting to think about how to re-rack looking forward, just given how much things have moved to start the year.
And we're like 3 weeks in, so that's a head scratcher for you. All right, Lisa, Zach, you guys are sticking with us. So joining us now, a look at the stocks moving ahead of the opening bell. Here's Abigail Doolittle. Abigail?
Well, Alex, we do, of course, have U.S. futures pointing to an up open for a second potential up day in a row after 2 down days. And helping out to some degree, well, Ford is now flipping to the downside. Earlier, it had been slightly higher. But initially, on the news that they are cutting their F-150 Lightning production, not for the first time, the stock had plunged nearly 2%. Then it flipped slightly higher, now a little bit lower. Investors not that move one way or the other. Amazon up about 0.5%. Their proposed $1.4 billion buy of iRobot is expected to be blocked by the EU's antitrust body. The deal could be bad, according to this agency or people close to it, for other vacuum companies. And then take a look at Spirit Airlines. The saga goes on, Alex, up 26.5%. They are saying that they're fully behind the possible buy by JetBlue. Of course, it was blocked by a judge after the DOJ also said that it's could be bad for consumers potentially. They're also talking about liquidity measures. They have not specified whether or not they will go through an appeal process, but I guess one would assume that is what they mean if they are still behind that deal.
Yeah, they're all for it. We don't know if that's actually going to mean anything. I wonder if we're going to see like meme stock trading with that spirit. All right, Abigail, thanks a lot. Coming up, Congress avoiding another shutdown for now.
Johnson wants things to go smoothly, and as you get closer and closer to November, you can imagine most of the GOP wants things to go smoothly as well, because they like being in the majority more than they like being in the minority.
And Ukraine aid and border security remain major sticking points. That conversation next. This is Bloomberg.
There are people within the Republican Party, very conservative, who want to renegotiate that, who want to cut spending even further than that agreement. And the Democrats and President Biden are holding firm. A deal is a deal. We're sticking to those numbers for the rest of fiscal year 24. That will be the fight. Johnson wants things to go smoothly. And as you get closer and closer to November, you can imagine most of the GOP wants things to go smoothly as well, because they like being in the majority more than they like being in the minority.
Congress voting to approve a temporary funding package, averting a partial shutdown for the government until at least March, but not without a dose of drama. House Speaker Mike Johnson rebuffing a last-minute effort by ultra-conservative members of his party to leverage the deadline to pressure border policy changes. Johnson using alternative methods, stalling Ukraine aid in hopes of unlocking tougher immigration measures. Now, once Biden signs the legislation, 2 new deadlines loom: March 1st and 8th. Bloomberg's Kaylee Lyons joins us now with more. Kaylee, it gives a little breathing room, but I don't know, March 1st isn't that long way of a way. What's going to happen over the next few weeks?
Yeah, 7 weeks for Congress to try to figure out an appropriations process that to this point, Alex, 2 previous continuing resolutions did not buy them enough time to do. This is the third stopgap measure we have seen Congress pass because it is that difficult to reconcile the priorities of a Republican-controlled House and Democratic-controlled Senate and White House. But they're going to try once again to do this by early March. Keep in mind those 2 deadlines in between them, Super Tuesday and the State of the Union, a pretty rife political period. Also, by March, we'll be about halfway through almost this fiscal year clear that this budget is supposed to be addressing. So that's how broken this process is. And just speaking to the difficulty of getting these spending measures through this Congress, 108 members of the House voted against this yesterday, including many members of senior Republican leadership. They voted against Speaker Johnson on this, not just hardline conservatives who wanted to see border security measures included in this stopgap measure. This speaks to the difficulty of getting a border security and Ukraine deal through the House. Yes, Senate negotiators are working with the White House on that package. The Senate is aiming to potentially get that to a vote on the floor next week, but it could very well be dead on arrival in the other chamber, as representatives like Marjorie Taylor Greene are actually threatening a motion to vacate against Speaker Johnson if he brings a Senate-passed Ukraine bill to the House floor. So his job could be in jeopardy, but the pressure on him isn't even just coming only from inside the Capitol building. It's coming externally as well from former President Trump, who has said on social media in the last few days that the House should only accept a perfect deal on the border. And Trump and Johnson have a very close relationship. They talk frequently about this, and Trump may want the border issue to be a live one throughout the remainder of 2024 as he competes with Biden theoretically for the presidency come November.
All right, Kayleigh, thanks a lot. Working, although snow is falling in D.C., which is a really big deal in D.C. I just want to point that out.
Yes.
All right, Lisa and Zach are still with us as well. Okay, so overall, what this does point out is there's still a lot of political risk, geopolitical risk, particularly as we head into the 2024 election cycle in November. Zach, do you need to hedge this right now?
Right now, it seems like a decent opportunity to consider the risks, just given, at least from a corporate credit perspective, things look pretty good. And when we think about the story of 2024, we think that there is a strong technical tailwind coming from perhaps money market fund cash coming out the duration and credit curves, but that's kind of overlaid with this rolling geopolitical and political uncertainty that we think is going to contribute to volatility. So you kind of have two clashing forces there. We think on net, things will proceed well, at least from a financial markets perspective, but we do think that the political overhang is only going to get worse from here.
Lisa, what do you think? I mean, typically in the equity market, if you try and hedge this kind of stuff, it never works out. Brexit was the best bet. What do you do?
You said it, right? It never works out. And what we've observed, quite frankly, over the last 2 years is that markets have become even more insensitive to geopolitical events, to headline risk. I mean, we've had wars, we've had various political headlines, threats of shutdowns. The market has continued to shrug it off. And, so what we're saying to our clients is, yes, this is a presidential year, presidential election year. It's also a year where there continues to be intensifying geopolitical stresses around the world. We need to be aware of them, but you cannot build a portfolio that way, trying to guess at the unguessable, because the market hasn't tended to price these things at all. Everything is looked through.
So to that point, Lisa, I'm wondering, when your clients ask about politics or geopolitics, what is their question?
Well, they always say, what's going to, the implication of this, red shirts, blue shirts on the market. We always dismiss that question immediately with the actual data that says it's irrelevant. We have good markets, bull, bear markets, regardless of who's in Washington. But what we do talk a lot about is policy. And what we've continued to say is, let's focus on what are the policy implications. And there, it's not entirely clear. We have some headlines, right, that say, if one party, the incumbent party, wins, we may see a continuation of the fiscal spending and some of the programs that President Biden has put in place and a sustenance of those. Alternatively, if the House changes control or the White House changes control, we will likely have a making permanent of the 2017 2018 tax cuts. Both programs are likely going to be deficit sustaining as opposed to debt reducing.
Yeah.
And so we try to talk to folks about, look, right now, those are the only policies really that people can identify in terms of the differences, but the outcome's the same, which is both put upward pressure on interest rates.
Right. Yeah, exactly. So, Zach, is that kind of how you talk to clients, too? Like the big takeaway, no matter who wins, no matter what happens, no matter what geopolitics works out to be, is that we're going to spend more money.
Well, that's kind of where I was going to go, Alex. In terms of the most underappreciated risk by the market, we think right now it's the possibility of higher rates again. I feel like it was a pretty brief trip to 5% on the 10-year, maybe more narrative driven around the supply concerns that we have for this year. But those supply concerns, at least from a logistical perspective, that supply hasn't hit the market yet. And so that's something that we're concerned about. And I think all of these political issues, political headlines that we can expect just kind of highlight that dysfunction and brings back kind of the Fitch ratings downgrade that brought into question the U.S. government's credit rating. And so I think that's one thing that we are talking to clients about now, and a way to position that is potentially duration hedges, especially if the Fed market pricing is way overdone kind of the way we think it is at this stage.
Do you anticipate, Zach, that you're going to see upward pressure on long-term rates, and also the Fed's going to have to be more active, maybe with hikes or at least not cuts, to manage any kind of deficit spending and inflationary impact?
I'd say we're concerned about the supply side of the story from a Treasury issuance perspective, and that's something that we're focused on. But when we think about what's going to overwhelm that, at least in terms of the shape of the curve and where rates go in 2024, it's going to be the monetary policy shift. And if you go back and look at Treasury supply concerns in the past, it's been more so the driver of yields in the shape of the curve has been these shifts in economic and monetary policy, not as much so the supply side. And so that empirically makes sense to us, but there are a lot of competing factors that we think will drive volatility in the meantime.
Guys, thanks a lot. Really appreciate it. Lisa Shallot, Zach Griffiths, appreciate your insight today. Coming up, you got the morning calls, and later, Dan Suzuki of Richard Bernstein makes the case for repositioning he may not like tech. This is Bloomberg. All right, time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, you get Oppenheimer upgrading AT&T to outperform, citing several tailwinds, like including improvements to network capacity and coverage. Then you got Stifel upgrading DraftKings to buy, the analyst seeing near-term headwinds abating. Plus, Evercore ISI upgrading IBM to outperform, expecting the company to benefit from a host of AI-centric tailwinds this year. So coming up, we're going to follow that tech theme. Dan Suzuki of Richard Bernstein on why he sees a once-in-a-lifetime reason to reposition portfolios as we head into a market that's looking at big tech at a record and the S&P nearing a record as well, as we're just about 4 minutes away from the opening bell. Happy Friday, guys. This is Bloomberg. This is the countdown to the open. Happy Friday. And if you had a playbook from the end of 2023, it is also a happy Friday. You're looking at NASDAQ 100 futures near a record. You're looking at the S&P futures near a record. And small caps are no slouch either, also up by 0.2%, but off the highs of the session. All right, let's switch up the board here as we get into the opening bell right there. You're looking at other asset classes. 10-year yield is just pretty much doing nothing, like maybe a little bit of pressure on the long end. The dollar, after a nice solid run over the last few days, taking a little bit of a break, and crude modestly higher, but honestly, the action's not there. I hate to say it, it's not there. It's in the equity market, and lots of different stocks moving for many different reasons, and one is definitely Spirit Airlines. The carrier saying it still plans to merge with JetBlue despite regulatory opposition. Abigail has more on that. Abby?
Yeah, this is an interesting one, Alex, and we do have the stock surging, heading to its best day right now since March 24th of 2020. This, of course, after losing about 80% in the 5 days leading up to today, having to do with that federal judge siding with the Department of Justice, basically blocking that big deal with JetBlue. Today, the surge has to do with three reasons. You mentioned one of them. Another, they're also saying that bankruptcy is not an option right now after the setback for the JetBlue deal. Second, they're also exploring liquidity measures. In one in particular, they're saying that they're looking to refinance possibly some of their 2025 maturities. On this, we have their junk bonds popping. And then third, that most interesting one, the idea that they're saying they're reaffirming the possible deal with JetBlue. They're saying that it, quote unquote, quote, remains in full force in effect. This, of course, is intriguing because of that federal judge blocking the deal. It suggests that they are going to appeal. In a filing, they didn't mention the appeal, but what they did say is that they continue to believe that a combination with JetBlue is the best opportunity to increase much-needed competition and choice. So it almost is setting up an early strategy to argue the exact opposite of the Department of Justice, plus to calm investors. Now, the company and JetBlue are reviewing the court's decision and considering their next steps. The stock is down 80% over the last 5 days, and basically that is also the amount that it's down from when this deal was announced back in July of 2022, Alex.
Can't help thinking this is a Hail Mary from Spirit at the end of the day. All right, let's turn to EVs because Ford is reducing production of its F-150 Lightning thanks to, guess it, fading demand. Ed Ludlow has more on that. Ed, I guess twofold question. Are you surprised by this and sort of what took it so long?
Yeah, I mean, how I'd view this is Ford carrying out or acting on the outlook it gave last month where it said it would cut production for the F-150 in half in 2024. What they are doing is cutting the specific workforce that is working on the F-150 battery electric pickup truck. It will impact about 1,400 jobs at the Rouge Electric Vehicle Center starting April 1st, when Ford plans to go down to just one shift at that facility. And as you said, the story here is that demand for electric vehicles continues to weaken. What Ford is saying is that it still expects growth overall in global EV sales in 2024, but that growth will be less than anticipated, and that outlook for growth was already depressed. And what I find interesting about this, as Ford is down a full percentage point at the open, is that they are actually boosting by 900 personnel those working on the combustion engine Bronco and Bronco Raptor SUV, Ranger Raptor pickup at the Michigan assembly plant. So taking from the EV workforce, adding to the combustion engine, and that kind of sums up where we're at right now with EV outlook in 2024.
Yeah, that truly is a perfect description of sort of where the industry is going to head in the short term. Ed, thanks a lot. All right, let's turn to chip makers now. You got TSMC's rosy 2024 outlook spurring a semiconductor rally and hopes of a broader tech recovery. This is now 2 days in the making. Alex Webb has more on that. Alex, what did TSMC do that really ignited this?
TSMC essentially said they're returning to the growth trajectory, at least partly, of previous years. Don't forget, last year they had a 5%, 4.5% revenue decline. There are two parts of their business that really matter here. There's the part that's exposed to smartphones and PCs. That's not been a terribly rosy industry over the past year or so. They also have, and they make the chips, I should add, for Apple in particular. The part that's really appealing right now is, of course, AI. They make the chips that are branded for NVIDIA, for AMD, that are driving, fueling this AI computing explosion. The fact that they are forecasting 20% revenue growth for this year is, of course, good news for their own investors. It is also now dragging up a little bit AMD and, to a certain extent, Intel, which has great exposure to data centers. All these AI chips are going into these kind of data centers, so that's why we see these positive knock-on effects.
All right, Alex, thanks a lot. Really appreciate it. And finally, let's turn to retail. Macy's and Wayfair now announcing layoffs as both are focusing on cost-cutting measures. Isabel Lee has more. Isabel?
Hey, Alex, it's a back-to-back layoff announcement, but you're seeing two very different reactions. Let's go to Macy's first. We have Macy's announcing a 3.5% cutting of its workforce. That's around 2,300 in their company, and mostly in corporate positions, and that comes ahead of the departure of their longtime CEO. The company is also closing around 5 stores. So it's been no secret that retailers, including Macy's, have been struggling as Americans shift their behavior from physical shopping to online shopping, and Macy's have posted annual revenue declines in the past year. So you can see the stock now down around 3%. Last year, it also ended the year lower by 2%. But Wayfair announced it's cutting 13% of its workforce. That's around 1,600 employees. This is the third restructuring, Alex, since the summer of 2022, and it's expected to save the company around $280 million. But you see that the stock is rising, so probably shareholders are looking at that as good news. Wayfair is up last year around 90%. So both these two aren't the only ones last year we had Hasbro and Etsy announcing layoffs as well. So it just really speaks to the competitive landscape. And of course, companies really trying to keep their margins up, Alex.
Yes, such a good point on the margin maintenance. All right, Isabel, thanks a lot. So Richard Bernstein's Dan Suzuki is optimistic for the year ahead. He writes this: when coupled with the prevailing bifurcation of sentiment and record market concentration, the current juncture may offer investors a once-in-a-generation opportunity to rebalance portfolios. And Dan joins us now. Dan, I'm so thrilled to talk to you. It has been so long since you and I have talked. It's good to see you. What's this once-in-a-generation moment that you're looking at here?
Yeah, Alex, it's great to see you. You need to fill in for John more often. Yeah, so I think that this is one of those once-in-a-generation opportunities. And, we put out a report last week, and I basically looked at the best performing trades of the last 50 or 60 years. And, the one thing that they have in common is, they start out with huge skepticism and scarcity of capital, but by the end, the dominant fundamentals get so exciting that they become, the only investment worth owning at the detriment of everything else. And so once you reach that point at which that's the only thing investors want to know, they'll pay any price to own it, that sets up for a huge underperformance and a rotation into a leadership elsewhere in other markets. So, you go back to as early as the 50s and 60s, you had the US Nifty 50, these huge blue chip, large cap stocks, which dominated their industries, had the best cash flows. That was the only thing you need to own. And then, the multiples got crazy, and it set up for 2 decades of underperformance for the U.S. Then you obviously had the tech and telecom stocks in the 90s. That's all you had to own with the internet wave. That didn't work out turned into the lost decade in the U.S. And then here, the last 15 years, we've had the rise of U.S. large cap growth and culminating with the rise of the Magnificent Seven. Again, these are the only stocks worth owning. That's usually a warning sign that the opportunities are probably elsewhere.
So I hear you, Dan. You could have made this argument, though, last July and also last December. So why is it the argument now with big tech?
Yeah, I think you could look at it from a couple different ways, Alex. I mean, one, from that long-term perspective, thinking about what the biggest trades are going to be over the next 10 years and what the worst trades will be. I mean, you've never before seen, relative to all those other, concentrated stories I've mentioned, this one is actually more extreme from a concentration perspective and a valuation perspective. The U.S. has gone from 40% of the global stock market to something like 63, 64%. The Mag 7 has gone from 7 to 30% of the U.S. And then on top of that, the U.S., trades at a record, premium to the rest of the world, 60% more expensive than everywhere else in the world. So there's that long-term story. But I think the question you're really asking, Alex, is, what's changed recently? And I think here it's really about the cyclical story. And I think that earnings, a lot of people would disagree, is going to continue to accelerate, as this recovery matures, but it's not going to be driven, by these, big growth sectors. Their earnings have been strong, but if you look at the earnings estimates, they're actually set to decelerate in the coming quarters. So what do you want to own? The sectors that are going to drive that acceleration. I think that's going to be small caps. I think that's going to be industrials, energy, emerging markets even. I just don't think it's going to be these names, and that's going to lead to some potential disappointments.
So you make an interesting point about earnings growth for those cyclicals. On the flip side, though, that kind of earnings growth doesn't square with 7 rate cuts priced in from the Fed. So does that mean that you expect the Fed to not cut as much? And then does that then have a knock-on effect into how those cyclicals perform?
Yeah, actually, I don't know that the Fed is going to be a huge swing factor. I mean, obviously, it's what everybody wants to talk about. I don't think that the Fed's going to cut 5, 6, or 7 times this year. I don't think they're going to be anywhere close to that. I just don't know that that's going to have a big, be a huge swing factor for markets. Ultimately, I think what's going to drive markets is going to be growth. And I think in the near term, growth is going to be better than expected. But as you get out to the second half of the year, I think the visibility is quite low. So you need to be on your toes and look out for those signals that perhaps at some point growth is going to be rolling over. But to be clear, we're just not seeing any of those signs right now.
So then if you take a look at the rotation that you're expecting then from big tech to the cyclicals, what does that rotation wind up actually looking like?
Well, I think this is actually a pretty classic rotation, Alex. I mean, there's nothing necessarily that unique about this particular earnings recovery. If you look throughout every earnings recovery, what happens is, people when earnings are terrible, are piling into the small and shrinking group of companies. They're able to continue to put up really strong growth. That continues to be the case, and why part of the reason why market leadership has been very narrow. But as growth broadens out and more companies can put up really strong earnings, there's a natural, the market becomes comparison shoppers. So why pay 30 times for the same growth that you can get for companies that trade at single-digit multiples? That's the sort of thinking that happens almost in every single earnings recovery.
So for the NASDAQ, though, for example, do we see a bear market in this sort of scenario that you're looking at? Or it's not that dramatic, it's just more about the cyclicals?
Yeah, I think eventually you are going to see a bear market. I've gone on so far as to say I think that this is a bubble, and I don't use that term lightly. So eventually that suggests that there's going to be a reckoning. I don't necessarily think that has to happen in the near term. I think initially, really the story could be underperformance as investors realize that there's other really attractive growth stories out there. I think maybe the next shoe to drop that really causes that potential downside for the sector is when things get really bad. Now, that could be 6 months from now, and that could be 2 years from now. But when growth really starts to roll over, I think people will be surprised, as they always seem to be, at how cyclical these companies' earnings are. Remember that if you go back a year ago, these companies that everybody have the best growth now, they were the ones leading us into the profits recession that we saw. So they are clearly cyclical. People just forget about that.
Totally fair. All right, Dan, you're going to stick with me. Dan Suzuki staying. Coming up, all eyes on earnings next week.
If you look at consensus estimates for this year, tech earnings are supposed to be up in double digits. Now, maybe it's not going to be quite as high as that for the year, but I think double-digit earnings growth out of, say, a broad NASDAQ 100 index is I think, what investors essentially are counting on.
That conversation coming up next. As you look at a Friday, we're seeing a little bit of upside in stocks. This is Bloomberg.
If you look at consensus estimates for this year, tech earnings are supposed to be up in double digits. Now, maybe it's not going to be quite as high as that for the year, but I think double-digit earnings growth out of, say, a broad NASDAQ 100 index is I think, what investors essentially are counting on. And so far, tech stocks have been able to deliver. So as long as we're in that range, it's better than about any other index can provide. And that's certainly why the enthusiasm is there, the flows are there, and also the valuations.
Earnings season kicking into high gear next week. Major airlines, a handful of consumer staples on deck. Abigail Doolittle is back with us for more. Abby?
Well, Alex, it's really pretty amazing because over the next 3 weeks, we will have nearly $30 trillion worth of market cap of companies reporting. Now, the bulk of that, of course, is big tech, and that's where a lot of the focus is, given their huge rally supporting these markets over the last year. But as you mentioned, lots of other companies reporting, including United Airlines. A big question there will be, will they follow in Delta's path and give a more conservative profit view than what will be expected? There's a chance that could happen. Higher wages could weigh on United's fourth quarter earnings as fares apparently are weakening and pushing their operating profit and margins lower. So stay tuned. D.R. Horton, the home builder. Now, their results will be a balance of looking forward and backward. Net new home orders may climb 37% in the first quarter versus the last year. But also, it's going to include the look back in terms of the 8% mortgage. What influence will that have? Order results typically leading, but because of that factor, we'll be looking backwards a little bit. Gross margins could be crimped by buyer incentives, but some analysts are saying December, that the color there could be good. And then finally, we'll also have some of the consumer companies reporting, such as Clorox and P&G. P&G will see broad-based organic growth sales, apparently, according to analysts, across categories and regions. Will that happen again? An unchanged guide there would be very good. And then 3M, the conglomerate, they're looking to see their sales declines basically level out, plus potentially a positive update around litigation and more information on the earplug settlement. Stay tuned, Alex.
All right, Abby, thanks a lot. Hey, just to update everybody, we are seeing the S&P rolling over a bit, right around the lows of the session. Still in positive territory. The NASDAQ still at a record, but we are kind of rolling over here, and the VIX popping a little higher. Again, still negative, quote unquote, but we are seeing a little bit of pop. So just watch this as we head throughout the trading day. Let's turn to tech now. You got Netflix, Tesla, Intel, and more set to report next week. Ed Ludlow is back with us. Ed?
Yeah, good morning, Alex. I guess that Abby gave us a good setup, but look at the gains of the NASDAQ 100 and S&P 500 in 2023 and the outsized contribution to those gains, both from a stock index performance, but also a profit contribution from the Magnificent Seven. Luckily, we kind of start earnings in earnest next week, slowly. And if you're to draw some commonality, look particularly to the chip makers, Texas Instruments earlier in the week, Intel on Thursday. After we had that kind of outlook from TSMC 24 hours ago, what we will look is to the chip makers and ask, is there recovery in end markets, broad end markets, right from sort of more analog semiconductors that go into cars and consumer electronics right through to PC and data center. Tesla will be the big one, and the narrative around Tesla is that they have this target of 50% annual growth, but we're in a 2% environment. You saw the Ford news that we discussed earlier today, that growth in EV demand in 2024 will be less than expected. Does Tesla maintain that 50% annual growth in that environment? And then beyond that, Netflix, I think there's a lot of confidence about Netflix that they finished 2023 strong. We have the writers and actors strike behind us. What does the content slate look like? But again, this kind of existential question of how do you be profitable in streaming will continue to be something that the street discusses in 2024. Then it's AI everything. And go back to December, our colleagues at the equities team in their Tech Watch column set it very clearly. The now expectation from the street is show us that AI is making a contribution to the bottom line. That will be the theme this earnings season.
Yep, straight up. All right, Ed, thanks a lot. Really appreciate it. So Dan Suzuki of Richard Bernstein still with us. So Dan, that kind of puts all stories together. Is it margin management? Like, is that the thing that's going to be their earnings season all about?
Yeah, I think it's really a tug of war right now, Alex. I mean, on one hand, you got margin management because you got pressures from labor costs, input costs, and interest costs. But then on the other hand, I think what you have is a lot of people are forgetting about is operating leverage. I mean, I think if you look at the last couple of quarters, what not a lot of people are talking about is you're finally starting to see top line sales growth accelerate. And that's what you really need to see. In every earnings recovery, it starts with margin expansion through cost cutting, and then you have to pass the baton to operating leverage. I think that's what you're going to start to see. That's what's going to drive this next leg of earnings growth here, and that's why you want to own those companies that are going to see that operating leverage kick in.
Where do we see, though, what about consumer demand in terms of those kind of stocks? Like, we're all waiting for that to sort of fall out of bed. We saw Wayfair and Macy's doing some layoffs. What do you think we see there?
Yeah, I think that the market tends to swing in these huge, has these huge pendulum swings in terms of the narrative, and it's usually not that extreme. So it's either, the consumer is accelerating and booming and going to the moon, or it's falling off a cliff. And I think it's much less exciting of a story. My personal opinion is if you look at the drivers of consumption like labor and wages and overall economic growth, it's going to be gradually slowing here. And so I think it's normal to expect that to gradually slow, but clearly not fall off a cliff. I mean, you're seeing retail sales, as everybody's cited, really strong. Their balance sheets are really strong. Interest rates are coming down. So there's no reason to think that they're going to collapse immediately. So I think that area of the market should be resilient. But we are, in my view, late in the economic cycle. I prefer late cycle plays, less, focus on the consumer.
Yeah, I'm not spending, Dan. I don't know if you know this, but I'm on a budget. It's a big deal. I'm definitely not spending, I promise. All right, Dan, thanks a lot. Dan Suzuki joining us. Really good to see you. Let's get some sector price action this morning and get to Bloomberg's Abigail Doolittle. Abby?
Well, after the last month, Alex, I'm not spending either. As for the sectors on the day, we have a small decline right now, gain for the S&P 500, but it is not a well-supported gain from a composition standpoint. Just 4 sectors are higher: communication services, tech, financials, and real estate to the downside, all the other sectors. So broad-based selling from a composition standpoint, but you have 2 of those sectors with big heavyweight weightings to the S&P 500, and the index is higher. Over the last 5 days, it's a similar story. We have just 2 sectors higher, tech and communication services, but big gains there. And for that reason, the S&P 500, I believe, is heading, to just a small gain. And it's interesting also to the downside, real estate and utilities, those are the worst 2 sectors. Those are defensive sectors, so in some ways you could say that's risk on. But the fact that you have 9 sectors down, 2 up, I don't know, Alex. Not great.
Yeah, it's looking a little messy there. All right, Abigail, thank you very much. Coming up, the market moving events you need to be watching. That's next in our trading diary. This is Bloomberg. fading the move a little bit, but the superlatives are still count. The Nasdaq 100 at a record intraday and record close. The S&P at a record close right now, but intraday we're still about 10 points off. So now it's time for your trading diary. What you need to know about the day ahead and what we're watching throughout the rest of the week. UMich, consumer sentiment, existing home sales coming at the top of the hour. Then check out Tuesday. We're going to get the BOJ rate decision plus Netflix reporting earnings, and tech earnings continue Wednesday. Tesla, IBM Thursday. ECB rate decision. We'll also get U.S. GDP, and American Express reports earnings on Friday. We're just getting warmed up. This was the countdown to the open. Happy snowy Friday, everybody. This is Bloomberg.